Buying an investment property shouldn't feel like gambling. When you run the right numbers, the decision becomes simple and predictable. What separates a great investment property from an average or a risky one? Hi, I'm Nick Ragan. I'm with the Ragan team over at Next Home Signature Real Estate. What separates a great investment property from an average or even a risky one? A great investment property performs well after the numbers have been ran and they're conservatively factored in. It's not always, if I have a house that's renting out for $1,000, for example, am I going to get $1,000 net to me as in profit? No, there's expenses that go into that. And we factor that into, we call it NOI, your net operating income, NOI for short. And that's really, at the end of the day, your return on investment. So we want to make sure that pencils in, but that's how you know if that pencils in right, you got yourself a great investment property. Now, when it comes to the risky side, you may have bought in an area that maybe there's a little bit more crime, there's a little bit more risk oriented with it. Maybe the rent growth isn't quite as great and the tenant market isn't as great. So you need to make sure you're running your numbers. There's tons of tools and softwares out there that show you what's good, what's not, but you also need to have help, and that's where we come into play. When I'm evaluating a property for investors, this is the first thing that I look at. Number one, I'm gonna look at that NOI, that net operating income, and I'm gonna factor in, we call it a cap rate or capitalization rate. How you factor that in the equation for it is you take your NOI divided by your purchase price, that gets you your cap rate. And you need to know what the difference between a high cap rate is or a low cap rate is. Low cap rates are usually a little bit more expensive properties, and high cap rates, the price is a little bit lower, meaning I'm getting a little bit higher rent, but I don't have the value built into the actual price. And the opposite is true for those lower cap rate ones. So we're looking at that, but we want to make sure that the expenses are ratioed in, the management's ratioed in, and the debt service is ratioed in. That's how you know you're getting a good investment. How do neighborhood trends or future developments impact your analysis? So when you're purchasing an investment property, whether it's a single family or a multifamily, maybe it's commercial, whatever it may be, you need to know the neighborhood trends. Are those trends negative? Or are they positive? Is there future development coming in? One company that does more research and development than any other company in the United States when it comes to real estate is a Starbucks. If you see a Starbucks around, we call it the Starbucks effect. That means there's going to be some development coming in, whether it's housing, whether it's apartments, whatever it may be. Usually we see it happen in droves fairly quickly. So those are just some little tips, but some other pieces that you can utilize to have in your tool belt. So here's a real example of an investment deal I helped someone find and really what made it a smart buy. I had a customer come up to me looking for some passive income. He had some cash laying around and he thought of, hey, why not real estate for tax depreciation purposes and the appreciation and some cash flow, obviously. He's on his way to retirement. We found a 13-unit apartment complex. He paid cash for the property. The gross rents are tremendous with some stabilization of rents, but also maintenance and some vacancies. He's gonna be sitting on a gold mine. But when we look at the numbers, we want to make sure that the actual valuation comes in much higher than what he purchased for, which it did. He ended up buying it for a great price. It was actually $140,000 less than what they were originally listed at. And then from there, we want to make sure that the gross rents are going to be about 1% or more of the purchase price. If that comes in above, usually it's going to be a pretty dang good deal for our guy on the other end. So, and that was the case. He ended up purchasing it for $950,000. His gross rents were roughly about $12,000. You factor in some maintenance in there, he's sitting down on a pretty good investment. So let me walk you through a real example that I did on my own for an investment property. I ended up buying, it was a side-by-side apartment complex, and it was an old mom and pop organization. They just wanted to get out. They inherited it from their parents. The rents were dilapidated. For this particular property, the rents were at $4,000 a month, and they wanted a hefty purchase price. We ended up coming at a number that worked for us and got it for $950,000. We ended up utilizing, we call it a reverse 1031 exchange, which means we collateralize other assets that we own, use that as the down payment to purchase this, and then when we sold those other assets, we pay off the reverse exchange. So we put it in a reverse exchange, and then the forward exchange is when we actually sell the properties that we own. So that's how we purchased it. But to get you back to the valuation of the property, and what we did is we ended up stabilizing rents, increased it closer to about 10 to 11,000 a month, and starting to make money. So those are just some examples that I've used with other individuals and how you can do it too. Here are some red flags that beginners really overlook when they're buying investment properties. So these red flags are the following. When we see investors come in that are new to the game, they think, I buy a property for X and it's gonna rent for Y, that's going in my pocket. No, not necessarily. There's expenses that factor in, and we need to make sure those expenses are really crystal clear. So banks evaluate properties differently than what you should evaluate for your information, but also to make sure that your calculations are right on. So banks usually factor in 5% vacancy, 5% maintenance, and we call it 5% CapEx, capital expenditures or improvements toward the property. It's about 15%. That comes right off the top for your off your rent. So your gross rent, so let's say a property is renting for $1,500 a month. Well, I factor in 5%, 5%, 5%. I got 15% right off the top right there that is coming off my bottom line. So I need to make sure those numbers are crystal clear, because guess what? If my debt service, meaning what I owe the bank every single month, is $1,200, $1,300 a month, and I'm $150 in expenses on the low end, the spread is just probably not there. So you need to make sure those numbers are crystal clear and you have a great idea before moving forward towards something. This is why Omaha is such a strong market for long-term investments compared to other cities. Omaha has great economic activity here in town. They always talk about there's more Fortune 500 companies here in Omaha than anywhere in the country. And there's a lot of great opportunities for tenants and landlords out there too. So number one, our rental growth is very strong here in town, as well as our vacancy. You can expect year over year 3% rental appreciation on your property to occur. Also, the appreciation of the value of the property goes up about 3% a year too, and that's pretty conservative compared to years past. And then you have to factor in vacancy. Our vacancy is very low here in town. We see, honestly, 100% occupancy if you're priced right. So meaning if the demand is there for your rental price, it's gonna rent out at the end of the day. And then you factor in all of this and you really just put it into all one, it's gonna lead to a great investment for you for the foreseeable future. Here's how I help first-time investors feel confident in the process. If you're a first-time investor, a lot of times you've saved up a lot of money to put down on a property. You need to make sure the numbers are accurate and they are crystal clear before you move forward towards anything, because there's nothing more frustrating than you sinking all this dollars and cents into one project and you can't recoup the cash back. So number one, you need to make sure you're purchasing right. You can't be purchasing top dollar in a neighborhood that's not going to support the valuation for long-term growth. So you need to make sure you're purchasing right to make sure that your debt service, the operations of the property, is lower so you can cash flow more in the end. Number two, we need to make sure the numbers are accurate. Are you buying a Class C to D neighborhood? Are you buying a Class A to B? Those numbers factor in too with occupancy and vacancy, as well as our rent growth. So that's really important for first-time investors to feel confident about before they move forward and making that step into that real estate venture. If you're an investor or just getting started in the investment game and you want a guide through the process, I'm here to help. Reach out anytime and we'll look at the deals together.